Good afternoon, everyone. This is my absolute pleasure to welcome you here at the LSE. I am Camille Landais. I'm a professor of economics here at the London School of Economics, and I happen to be also the director of STICR, the Suntory and Toyota International Center for Economics and Related Disciplines, as well as the new co-director of the recently launched Stone Center for the Study of Wealth Inequality here at the London School of Economics. Before we start, as always with public events, I am compelled to share with you some housekeeping notes, in particular with respect to fire alarm. So if the fire alarm sounds, actually you need to exit the theater using the nearest available exit. Follow the instruction of the LSE staff, okay? In terms of how we're going to organize ourselves today, so we're going to have first Gabriel present his new book. We hope for maybe a presentation of 40-45 minutes, after which everyone will have an opportunity to participate in the Q&A. We'll open the floor to a question. And that's very important. After the lecture, we're going to have a book signing and a little drinks reception to which you're all invited, and that's going to happen upstairs. I'll give you more information at the end of the lecture, okay? But yeah, rest assured that after this lecture, you guys will have a drink. So I'd like now to introduce my good friend Gabriel. It's a genuine pleasure to welcome Gabriel Zucman to the LSE for the launch of his new book, We Need Tax Billionaires. The title is admirably direct, and you will see the presentation is very compelling as well. Gabriel is professor of economics at the Paris School of Economics, as well as the University of California in Berkeley. And before that, he was also at one of the world's finest universities, the London School of Economics, of course. And so we're especially pleased to welcome him back tonight. Is, as most of you know, one of the world's leading economists. He works on wealth inequality, tax evasion, and the measurement of wealth. Many of you, I think, know him, for instance, for his work on tax havens and the role they play. Some of you might have read his book, The Hidden Wealth of Nations. It's also available outside. You might also know his work with Emmanuel Saez on progressive taxation and the measurement of wealth inequality, which led to a very important book as well, The Triumph of Injustice, which is also available outside. What's really important about his line of research is just how much it has forced us economists to rethink about our traditional models. And in particular tonight, the new book that he has written makes a very clear and direct case for why the taxation of extreme wealth matters. I think the best is that we hear it from him. So please join me in warmly welcoming Gabriel to the
Thank you. Thank you so much. Such a great pleasure to be with you today, to be back at LSE after all these years. Have so many wonderful memories of my stay there. And so it's a very great honor and personal pleasure to be here. So I want to start with what is perhaps one of the most striking and most important evolutions of the world economy of the last decades, which has been the explosion of extreme wealth. It's a phenomenon that started in the 1980s that has accelerated after the financial crisis of 2008, 2009, and now there's an acceleration of the acceleration, if you want, over the last couple of years. The graph shows the amount of wealth that's owned by global billionaires, according to Forbes magazine, started in 1987, relative to world GDP. So today you have about 3,000 billionaires, according to Forbes. In reality, probably more than that, but that's those that they keep track of. And in 1987, this group of the world population owned in wealth the equivalent of 3% of world GDP, okay? Meaning if they had spent all their wealth in 1987, they would have been able to buy the equivalent of 3% of the value of all the goods and services produced globally that year. Okay. Today, it's 17%. So we're talking about 3,000 families who they spend their wealth, they could buy 17% of all the goods and services that are produced in a given year today. So why does that matter? This matters because with the upsurge of billionaire wealth, there's been an upsurge of their influence and of their power. And frankly, a lot of what's happening in our democracies today is downstream from the explosion of billionaire influence. And that's for a very simple reason. It's just because wealth, for most people, wealth is a good thing, right? For the middle class, it's owning your home, it's retirement assets for your old days. So we'd like to encourage wealth accumulation by the middle class. We'd like the working class to have access to wealth. It's largely excluded from property ownership still today. Its total wealth for the bottom 50% of the distribution is still about zero. Their assets are about as large as their debts. We'd like more wealth for most of society. Wealth is a good thing. But for the billionaires, of course, wealth is not safety. They're not accumulating billions for their old days. Wealth is power. And extreme wealth is always an extreme power. It's always the power to influence the prevailing ideology by buying newspapers, media, TV channels, radio stations. It's the power to influence markets by buying competitors in particular. It's the power to influence policy making. It's the power to influence elections, to buy elections. And there's always, in all democratic societies, a fundamental tension between extreme wealth on the one hand and the very possibility of a well-functioning democracy on the other hand. It's something that all the thinkers of democracy have written about all the way back to Aristotle and through to the founding fathers of the US, and today someone like Lea Ypi here at the London School of Economics. All the thinkers of democracy have highlighted this fundamental tension. And so that's why what's happening, what we can see in that chart here, matters a lot, not only from a purely economic perspective, but more broadly for the future of our democracies. Now, that was relatively well known, but what was not well known until very recently was how much tax the super rich pay. There's a lot of opacity about that. Our public statistics are silent about this issue, about the wealth of the super rich, the income they earn, or the taxes that they pay. There's just no public data about that. And it's only relatively recently that this opacity has started to dissipate, thanks to a new international research effort. And this is kind of the story that I tell in the very short book. You know, it's telling the story of this new research, which started in 2019 when Manuel says we did the first study of how much tax the billionaires pay and how we can compare that to the effective tax rates of the rest of the population. And you know, the study had all sorts of limitations. We didn't have access to all the data. But the main merit is that it encouraged different teams of researchers in different countries to do the same in their own country. And so now we have very good studies for France, for the Netherlands, for Italy, for Norway, Sweden, Brazil, and more countries, about a dozen countries now, where economists were able to partner with tax administrations to dissipate this opacity. So essentially to link businesses to their owners, to be able to measure the true income of the very rich. And their income is mostly profit from companies that they own, hence why it's so important to know what companies they own and how much tax they pay directly and indirectly through the corporations that they own. And so it makes it possible to compute total effective tax rates for the very rich that are comparable to those of the rest of the population. There's a long tradition in public finance of trying to estimate the distribution of taxes, and it goes back to the 1940s, a book by two economists in the US, Gerhard Kolm and Helen Tarasov, Who Pays the Taxes, the first attempt at measuring how effective tax rates vary across the distribution, but those studies were silent about the super rich. And so now if we try to kind of continue this research agenda, here is how the picture looks like. So on the x-axis, you have the different groups of the population. P010 is the 10% of adults with the lowest income. P10, 20 is the next decile, and so on. And you have a zoom all the way up to dollar billionaires, who are both at the top of the wealth distribution and at the top of the income distribution. And then on the y-axis, you have their total effective tax rate. What does it mean? It means the total taxes that they pay, all taxes included, VAT, other consumption taxes, payroll taxes, income tax, corporate taxes allocated to the owners of the corresponding corporations, everything divided by their total income. Okay, so that's the most comprehensive and comparable and consistent measure of tax burdens that you can think of. And so here's what you see. So first of all, you see that in all these countries, the working class, let's forget about the US for a second. I'll get back to the very specific US case in a second, but let's look at the European countries on the chart. You see that the working class pays about 40%, defined as the bottom 50% of the distribution, pays around 45% of their income in taxes. The contrary to a widely held view, low-income people, they do pay a lot of taxes. They do pay VAT, they do pay consumption taxes, they pay payroll taxes, and so on and so on. Then it rises a little bit for the middle class. Then again, it rises perhaps a little bit for the upper middle class. So there is some very mild progressivity in taxation. And then there's kind of a collapse, a total collapse of effective tax rates, all the way down to 15 to 25% for billionaires. And so here you have what is, in my view, a grave anomaly. A grave anomaly, because of course there's a legitimate debate to have about the proper degree of tax progressivity, meaning the extent to which the rich should pay more tax relative to their income than the rest of the population. And it's okay to disagree, and more right-wing people will want less progressivity, more left-wing people will want more progressivity. It will always be a central topic of debate, of political conflict, and that's okay. It's easy to get it wrong, to have too much, too little progressivity, that's fine. But no one, and I should support, and I think fundamentally no one agrees with a situation where the wealthiest people in society are able to pay much less tax than the rest of the population. It's just a violation of the basic principle of equality before the law, which is at the core of our democracies, of the rule of law. And equality before the law in the realm of taxation, it means equality before the tax law. The most conservative interpretation that you can make of that principle is that the tax system shouldn't be regressive. The super rich shouldn't be allowed to pay less than the rest of the population. And that's the situation we're in today. And in all these different countries with different teams of researchers applying the same methods, making things comparable, everywhere, this is what you see. That's a problem. So first question is, where is the problem coming from? And the answer is that the problem is coming from the failure of the individual income tax, the progressive income tax. Its failure to effectively tax the super rich. Here it's the same chart as previously, but focusing on just this one tax, the progressive income tax. Rank people by their income, you look at their effective income tax rate, income tax divided by total income, pre-tax income. And the progressive income tax, first of all, was a big revolution, a big democratic accomplishment of the beginning of the 20th century, late 19th century, a big international movement where different countries at roughly the same time start creating their progressive income tax. In 1909 in the UK, 1913 in the US, 1914 in France. And it was a big revolution. Right? Because before that, centuries, millennia before that, taxation was based only on consumption taxes, very unfair, or on flat income tax that didn't depend on one's income. And then it changes at the beginning of the 20th century. We start taxing income progressively with higher rates for wealthier people. And you can see that, and back in the days, there were huge debates about that. I'll get back to this. It was very controversial. And now it's widely accepted. And the income tax, by and large, works quite well in the sense that it's progressive indeed for most of the population, but up to some point, right? And then you can see in those different countries, past some threshold, which can be really high, can be above tens of millions of pounds in wealth, very high. It can be very high, but past some threshold, the income tax rate collapses. And it collapses to really, problematically low numbers in many countries. Like, Netherlands, for billionaires, it's 0%. That's not a lot. Norway and Sweden, it's really an interesting case. We studied those countries with my colleagues, David Syme and Marius Ring, and we approach Norway and Sweden thinking, let's look at the countries that must do things right. If there's one country where they found a way to tax the rich and there will be lessons to be drawn from these countries, it must be those Nordic countries. They're doing so many things, right. And it turns out that it's almost the opposite. It's the worst. In particular, you look at Sweden on the chart here, and it's in Sweden that you have the largest gap between what kind of the middle class pays in tax, 55%, and what billionaires pay, which is just 14% in Sweden. Well, anyway, closing the parenthesis, the reason for that is the income tax vanishes literally for the extremely wealthy. And why does the income tax vanish? It's because fundamentally, past a certain level of wealth, it's very easy to structure your wealth such that this wealth will generate no significant amount of taxable income. There was a striking illustration of that a few years ago in the US when you had revelations by the US media ProPublica on the taxes paid by US billionaires. And you saw people like Jeff Bezos or Elon Musk reporting very little income, paying very little in income tax. There's even one year when Bezos says, okay, look, I'm so poor that I'm going to claim family benefits. Okay. And he receives family benefits. He receives a check for his children. He receives money from the government instead of paying taxes. And there's nothing illegal in that. Don't get me wrong. It's not fraud. It's not tax evasion. It's perfectly legal. It's the way the income tax works. If you have found ways to pretend that you don't have income, you have no income tax to pay. And so as CEO of Amazon, he didn't pay himself any wage. As controlling shareholder of Amazon, he instructed Amazon to not pay out any dividends, so he had no dividend income. He didn't sell shares in Amazon, so he didn't realize any capital gains. So his taxable income was really low. He looked very poor from the perspective of the income tax law. But of course, his true income, his share of Amazon profits, Amazon is making tens of billions in profit, is really high. His wealth, of course, is extremely high. So his true ability to pay taxes, no matter whether you look at true income or wealth, is really high. But our income tax systems fail to effectively tax extremely rich people like him. And so what we've learned from the research that was conducted over the last 4 or 5 years is that the problem is not just a few isolated cases like Bezos, it's a structural problem. And what we learn is that it's in fact even worse. And I was very surprised about that. It's even worse in Europe than in the US. You can see it on the chart. I'm not here to praise US billionaires. And we can see on the chart that they don't pay a lot of tax. But still, it's a bit more than the European billionaires who are really close to zero. And what's the reason for that? There's an interesting story behind all of that. The story is that, well, before explaining the story, let me explain why the European billionaires pay so little. Why they pay so little is that because they use a specific type of tax avoidance, which is known as the use of personal holding companies, a bit like shell companies. So they put their wealth in holding companies, and then it's the companies themselves that earn income, mostly dividend income. And because on paper, because these are just accounting games, it's all on paper, because on paper, the income is paid not to individual persons, but to companies, there's no individual income tax that's owed. And because the dividends are in fact tax-free, dividends earned by holding companies in almost all countries are free of corporate tax, of company tax. They pay no individual income tax, and the holding companies themselves, they pay zero or almost zero. And so that's through those gains, disconnecting themselves from their wealth, putting their wealth in holding companies, that European billionaires managed to pay so little income tax. Now, in the 1930s in the US, in 1933, the New York Times revealed that JP Morgan, one of the wealthiest person of the time, had paid no income tax in 1931 and 1932. And at the time, the Americans, they were very upset. Okay, so you had hearings in the Senate, you had an investigation by the US Treasury, and in 1937, it was under the New Deal, first of all, they discovered that part of the reason why people like Morgan could pay no income tax was precisely because of the use of holding companies. And second, they said, that's not normal. We're not going to allow that. And so they changed the law. They created what's known as the personal holding company tax, which is a very high tax if you use holding companies. And so essentially, they shut down that specific form of tax avoidance. And so that's why in the US, the billionaires pay a little bit more tax than in Europe. That's because they cannot do these paper gains that involve holding companies. They cannot do it since 1937. But here, and it's true in the UK as well, just like in the EU, it's still possible and it's widespread. Okay, so that's the reason why the billionaires pay so little. Now, to some extent, there has long been a recognition that the income tax is limited when it comes to taxing the super rich. And it's always been the main argument for having a wealth tax. Okay, and so you have many countries, you've had many countries over the course of the 20th century who have had progressive wealth taxes. And with many of our colleagues, Camille, many others, we've studied the historical experience with wealth taxation. Has it worked? Do wealth taxes as they have existed or still exist today in countries like Norway or Switzerland or Spain, do they work well? Do they really make the rich pay their fair share? And the conclusion from that is that essentially, no, they don't work. They don't work. I know it's a bit shocking, but it's an argument that's often used by opponents of wealth taxation. They said, we've tried wealth taxes in the past and, it didn't work very well. And I agree with that. Of course, you can look at that failure and you can say, okay, we've tried those wealth taxes, they didn't really work, hence they will never work, and so let's stop thinking about that. Or you can look at that history and say, okay, let's try to learn about the mistakes that were made. Are there lessons to be drawn? Can we do better in the future? And of course, it's going to be the perspective that I'm going to adopt in a second. But before talking about that, why have they failed? Why are they still failing in the countries that still have them? Well, they failed because, first of all, the super rich, by and large, have been exempted from those wealth taxes. And I tell the story of France in the book, which is a pretty shocking and frankly disturbing story, where in 1981, the Socialist Party wins the presidency, has an absolute majority in parliament, and they create a wealth tax. But then immediately, the year just after that, they say, wait a second. Are we sure we want to do that? And they start to introduce exemptions, and in particular, one big exemption for so-called professional goods. They invent a notion that doesn't exist in any economics textbook of professional goods. Never heard of it before. And they say, okay, what is a professional good? Professional asset, professional good is if you own more than 25% of the shares of a company, we are going to call that professional assets, and we're going to exclude that from the wealth tax. We're going to say that's going to be exempt from the wealth tax. But that's exactly the wealth of billionaires. No, that's what it means to be really rich. It's owning a lot of shares in big companies. And so, you have the Socialist Party with all power, 81, who exempt billionaires from wealth taxation, the wealth tax that they themselves had just created in France. And that's the reason why, if you look at the effective, if you look at total taxes, income taxes and wealth taxes paid by billionaires in France, relative expressed as a fraction of their wealth, in 2016, which is on the eve of the abolition of the wealth tax in France, you can see, I don't know if you can see it, but there is a black line here, which is the effective wealth tax rate of billionaires in France, 0.005%. Colossal intellectual and political failure. We create a wealth tax, and the wealthiest people in the country, they just don't pay it. Norway does a little bit, does better, but still, and it does much better, to be honest, but still, the total tax rate of billionaires in Norway, income tax plus wealth tax, still adds up to only 0.4% of their wealth. That's really tiny. Okay, even with its wealth tax, Norway taxes billionaires less than the US. It's not a good performance. So that's the limits of the historical experience with wealth taxation. And that's kind of the motivation for trying to think about something a bit different. Let's try to do a bit better than in the past. Let's try to learn our lessons. And so that's thinking that many of us, Camille, many others, have contributed to how can we create today an effective taxation of the super rich? And in 2024, I tried to formulate a proposal for the G20 when Brazil had the presidency of the G20, and they wanted to put on the agenda of the G20 some new ideas for international cooperation. And so they asked us, okay, what should we do? And what I told them is in 2021, you had 130 countries that were able to agree on a minimum tax for big multinational companies of 15%. The G20 had played a very useful role in that. And so I told them, look, I think the G20 should try to push for doing something equivalent for billionaires. It's the same problem as for multinationals. These are some of the main winners from globalization, but they pay very little in tax. And there should be a floor. The minimum tax is a powerful tool because it targets all possible forms of tax avoidance. You don't have to specify that you're targeting this or that scheme. You're saying at the end of the day, if you're extremely rich, you have to pay at least X. And so that's the basic idea of the tax. That's really totally consensual and very simple. It's just the idea that if you're extremely rich, we can debate what it means, but I've proposed $100 million because this is where in all countries the income tax vanishes. If you're extremely rich, you should pay an unavoidable minimum each year. Okay, I think, who can be against that? Who is in favor of the right of billionaires to pay zero? Absolutely no one. Okay, so that's a good start. We all agree there should be a floor. Now, for the floor to be effective, it shouldn't be computed as a fraction of income, because the whole problem is that the billionaires find ways to report no income. So Bezos has no income. If you create a minimum tax on income, he has to pay 25% of zero, which is zero. It's brilliant. The French government did it 18 months ago. They passed a minimum tax based on income. The billionaires did not complain. Nobody heard about it. It generates no revenue, and that's what they did. It is not a good idea. For the minimum to be effective, it has to be expressed as a fraction of wealth, because wealth is much harder to manipulate. And so then the thinking was, okay, what is the rate that everybody can agree on? Because remember, we are the G20, so you can't be extremely ambitious. The idea is to put something on the table that's going to be viable in a forum like that. And so the computation was, okay, what's the rate which is going to erase the regressivity that we see on that chart here, which is going to ensure that the billionaires pay as much, not even more, but as much tax relative to their income than the rest of the population. And the answer, broadly speaking, is 2%. Okay, so if you create a minimum tax for people with more than $100 million in wealth, equal to 2% of their wealth, you get rid of this anomaly that the research has highlighted. So that's the proposal. That's the proposal in the G20 report. That's the proposal that I detail in the book. And that's the proposal that was adopted by the French National Assembly last year, in February of 2025. And then it was blocked by the Senate. And so it's not yet enacted into law in France, but it's going to come back in the debate very soon. And we see similar initiatives that are bubbling up in Belgium, in the Netherlands, perhaps soon in Spain, perhaps soon, I hope, I'm going to talk about the UK in a second, perhaps soon in this country. And there are three reasons why we need it. Number one is just equality before the law. Let's get rid of the anomaly. So what the chart shows here is if you have this 2% minimum tax, that's how our tax systems would look like. You know, instead of the effective tax rate of the very rich falling to about 20%, they would pay as much, broadly speaking, as the middle class. It's not, you know, as anyone can see, it's not very ambitious, but we can all agree on that. We have to reaffirm the principle that if you're extremely wealthy, you cannot live in some parallel society. You have to contribute, like the rest of the population. If you've become really rich, it's in large part, because you've benefited from public spending, on infrastructure, on education, sometimes subsidies. And so, you know, it makes it even more unacceptable that you should be allowed to pay less than the rest of the population. So with 2%, you get rid of that anomaly. So that's number one. But the second reason is the sheer amount of tax revenue at stake today. Because in the 1980s, 1990s, before the explosion of billionaire wealth, you could say, well, okay, perhaps they don't pay a lot of tax, but they're so few in number that, you know, we don't care. You know, who cares? And there's not a lot of money at stake. Now, that's not true anymore. Now there's a lot of money at stake. So now if you take the data from the Sunday Times rich list, data that was compiled by Ben Tippett here, first year of the ranking is 1989. The 200 wealthiest families in 1989, so the 0.001% richest people in the UK, they owned in wealth the equivalent of 5% of UK GDP. Okay, so it means if you tax that at 2%, you get 2% times 5%, you get 0.1% of GDP in additional tax revenue. You can say, you know, not a big deal. If you only care about public finances, right? Forgetting about inequality, forgetting about equality before the law. But then something happened in the UK, like everywhere else in the world. The wealth, and here it's just looking at the wealth of resident billionaires, you know, removing those who don't live in the UK. Just focus on those 200 resident billionaires. Well, they own more than 700 million pounds today, and they own in wealth the equivalent of 20% of UK GDP. Now, if you add also the wealth of those between 100 million and 700 million, you can estimate that ballpark number, conservative estimate, the wealth of the roughly 1,000 families who have more than 100 million pounds in the UK adds up to the equivalent of 25%, perhaps 30% of UK GDP. Okay, so now if you tax that only at 2%, we're talking about 0.5%, 0.6% of GDP in additional tax revenue. We're talking about 15 billion, 20 billion pounds per year in additional tax revenue from 1,000 extremely wealthy, under-taxed families. So now, even if you don't care about inequality at all, but just you want to balance the books, you want to have a budget that works, you have to care deeply about that question. I'm not saying it's going to solve the public finance problems of the country, but it's also very difficult to see how we can solve our public finance problems in the UK or in France as long as we don't tackle that problem. You know, the sheer amount of revenue at stake now is really large. And so, of course, then there is the bigger issue, of course. The bigger issue is the issue of democracy. And moving back for a second to the case of the US, where the trends, of course, are the most striking and the most worrying, if you try to kind of visualize, in some sense, the oligarchy drift of the US, I think that's the clearest chart. It's focusing just on the really very top, you know, the top 0.0001%, which is 19 households today, 4 households in 1913. The advantage of looking at the very, very top is that you can go back to 1850 because you always have rankings of the super rich. So back to the middle of the 19th century. So you can see the US had its famous Gilded Age at the end of the 19th century, early 20th century, with the big monopolists of the time accumulating enormous fortunes, Rockefeller, Carnegie, and so on and so on. But what's happened, it really pales in comparison to what's happening today, where the wealth of the oligarchs today is equivalent to 14% of US national income, as opposed to 4% at the peak of the Gilded Age. And you see the kind of vertical increase that's happening, over the last few years. And of course, we all see how that wealth translates into enormous political power with, someone like Musk, who could have a cabinet position plugged on the servers of the federal government with total freedom to slash federal spending that he didn't like. And that just highlights that we are at the juncture where it's becoming obvious that the battle, of the 21st century is going to be that battle between oligarchic forces and democratic forces. And it's going to be a fierce battle. And I think when you look at that chart, you can say, well, it's hopeless. No, the battle has been lost. The influence of the truly wealthy is just so overwhelming that there's just no hope in changing that in any meaningful way. And I think that's not quite true. I think that's very wrong, in fact, and I'm a big believer in the power of democratic forces. And the reason why I think there are very good reasons to be optimistic is if you look at history, and the closest historical precedent for the situation today is, in many ways, is the movement around the birth of the progressive income tax. And it was a very fierce battle, at the beginning of the 20th century. The super rich didn't pay tax. And all of a sudden, you have a number of governments who say, look, no, perhaps you should pay a little bit. In the UK, it's the famous People's Budget of 1909, Lloyd George, where he says, okay, we need to fund workers' pensions. And so we are going to create a super tax of 2.5% on income for the 10,000 wealthiest people in the UK, which would come in addition to the flat regular income tax of 2% that existed since 1843. So it's the birth of the progressive income tax. And, it's a huge battle. And the House of Lords vetoes the super tax, the People's Budget, which then leads to the Parliament Act of 1911 that removes the veto power of the House of Lords. So it's an epic battle, but it's a battle that eventually was won, right? The income tax the progressive income tax not only was created, but then it became extremely progressive during the course of the 20th century, with, in fact, in the UK, top marginal income tax rates that went all the way up to nearly 100% after World War II. It was the pillar of the modern tax system of the country, and also the pillar of what made possible the rise of the social state, the rise of the welfare state. So it was really a tremendous accomplishment. And the UK was a leader. 1909, one of the first countries to do it. France did it in 1914. The US did it in 1913. The US had to change its constitution to pass the 16th Amendment to create a federal wealth tax, federal income tax. In France, the Senate blocked the income tax for 5 years between 1909 and 1914, but eventually it passed. And basically, what's happening today, perhaps, nobody can know for sure, but perhaps is to some extent a repetition of what happened at the beginning of the 20th century, the beginning of an international movement to complete the revolution that was the creation of the income tax, bring the super rich into the system. And so, of course, the question is, we need one country to start doing it and to start this international movement. And the UK often leads, on these issues, whether it's the progressive income tax of 1909, whether it's the creation of the welfare state in 1945. In the opposite direction, whether it's the turn to neoliberalism in 1979, Thatcher a bit before Reagan, or the turn to neo-nationalism with Brexit, a bit before Trump. But UK is often a bit ahead of the curve. And so I count on you to be a bit ahead of the curve again this time with a new people's budget that will say, okay, look, the time has come, right? When we see that chart, I think we can all agree that the time has come to make sure the billionaires have to pay a minimum, a bit like Lloyd George, 2.5% was really a low rate to kind of highlight the kind of selfishness of the aristocrats of the time who didn't want to pay tax. And that's a bit the same strategy with this minimum tax of 2% on wealth. Now, let me just conclude by saying, of course, the concern when one country on its own does it alone, always the debate is about, oh, but the rich are going to move. They are going to relocate to Dubai, to Monaco. And so everything you've told us, that's fine, it's a nice story. But now if we were to press the button, it would be like shooting ourselves in the foot. It would be self-defeating. It would be a terrible idea. Now, the most important thing to remember from this whole discussion is that this view is wrong and that it's possible to address this risk, which is real, of out-migration by the very wealthy. What's really important to understand is that this tax exile is not a law of nature like gravity. It's a choice. We choose to tolerate it or to encourage it sometimes, or we can choose to fight it. And so how can we fight it? It's not very complicated. There are different ways to do that. The system that I would defend, that I think is most logical, is to say that if you've lived for a long time in the UK and you became really rich in the UK, and now you move to another country, then the UK should keep taxing you after you've moved, as if you were still a tax resident of the UK for a number of years, like 5 or 10 or 15 years, we can discuss. So that it would be neutral from a tax perspective to live in London or in Dubai or in Monaco. It makes no difference. The logic is unbeatable. The logic is if you've become very rich in one country, it's obviously because you've benefited from public spending. And so there's just no right once you've become very rich to secede and have no tax to pay anywhere in the world. Now, and plus, you've benefited from all the knowledge that's been accumulated over centuries by all of humanity, right? So you have a debt towards humanity. So now if you decide to move to a country that does not tax you, fine, that's their right. That's your right. You can move. That's okay. But if your new country does not tax you, then the country where you built your wealth is going to collect the taxes that your new country chooses not to collect. Is going to play a role of tax collector of last resort. So that if you move to another country that taxes you as much as the UK, you don't have any extra tax to pay to the UK. But if you move to a country that does not tax you, then you would have to pay the UK taxes as if you were still living in the UK in full. So that's the system that I think makes most sense. You don't need an international agreement. Any country on its own can do it. It will remove any incentives to move for tax reasons. And so it makes it possible for any individual country to finally start taxing its billionaires. So once again, I count on you and thank you very much.
Thanks a lot, Gabriel, for this extremely compelling expose. I'm going to open up for general discussion, but before I do that, I'm going to just take the opportunity to ask a first question that seems extremely important to me, especially as we open the debate to economists. A question I'm being often asked when I talk to colleagues about why there is a need for such a form of wealth tax on the super rich is, but don't we have the tools? Don't we already have a set of policies from inheritance taxation to area of income taxes, taxation of capital gains? Why can't we just use those tools? Why don't we need to invent something else? at the end of the day, all that money that is created, all these profits that are retained in companies, at some point they're going to need to circulate, they're going to be distributed to your heirs, or so why can't we use the tools that we currently have to tackle this issue of extreme inequality in front of taxation?
Yeah, absolutely. I mean, that's indeed a common argument, and I think the way I would approach it is by looking at what the different countries do, and let's look at the countries that have the best functioning income tax. And perhaps surprisingly, but I think it's fair to say that at that stage, especially when it comes to the very top, it's the US. Because of the reasons, the personal holding company tax of 1937 in particular. But you can see that even in the US, with the most robust income tax, even in a country that tried to confront those issues, under Roosevelt, of tax avoidance by the very rich, very seriously a century ago, even in that country, it doesn't work very well. And the reason why it doesn't work well is because you can try to plug one loophole, like personal holding companies or trusts or this or that or capital gains. But fundamentally, very rich, they're well advised by well-paid accountants and tax lawyers, and they find ways, right, to avoid taxation. And that's why it's more powerful to have a minimum tax that says no matter what you do, we're not going to try to list the thousands ways that you can avoid the income tax, and we're not going to plug all of those holes. No country has been able to do that historically. So we're not going to try to do that. We're going to take a much simpler approach, which is whatever you do, at the end of the day, you won't be able to go below the floor, 2% of wealth. I think that's much more powerful to do it that way.
Okay. Sorry, I'm just going to add one more important question in line with this, and then I'll open the floor to questions. Clearly, having a minimum wealth tax is addressing this ability to use other forms of avoidance, such as optimizing the way you realize your income and things like this. The one thing, though, that seems extremely relevant is that for it to work, you need to be able to observe who owns what. And that's, in some sense, the ultimate form of avoidance. In what sense would you say that it's the first battle, building that state capacity of observing basically who is the ultimate owner of what, and where do we stand today in that battle?
Yeah, absolutely. I think the way I view it is that and it's also connected to your earlier question, is that the very notion of income for the extremely wealthy is not very well defined. And we could see that in the example of Bezos, where there can be such a huge gap between certain notions of income, like his share of Amazon's profit and what he has to report. So it's not very well defined. But wealth itself is well defined in our market economies with well-defined property rights. All assets have a legal owner. And even if they are owned through intermediate entities like trust or what have you, at the end of the day, there is someone who has the power to sell the asset, who's the legal owner of the asset. And so that's what makes wealth fundamentally a better base for taxation for the very rich. And so that's one thing. And then if you tax those, if the tax is on those who have more than 100 million pounds, let's say, in wealth, what you have to realize is that at that level of wealth, wealth is in fact quite simple. Sometimes people think, oh, it's all very opaque and very hard to measure, and we have no idea of what they really own. But in reality, at that level of wealth, more than 90% of wealth corresponds to shares in companies. Half of that is going to be shares in publicly listed companies where you have a clearly observable market value. And the other half is shares in big private companies, not listed on the stock market. But by definition, because we're talking about very rich people, these are going to be big private companies. And we know how to value big private companies. That's what lots of people in the financial industry do every day. You look at how similar companies that are listed on the stock market are valued by the stock market. So that's what makes wealth relatively easy to measure and to value for the super rich. Now, of course, there's more than that. There's also yachts and Picassos and what have you. But those paintings, they're insured typically, and so there's an insurance value that you can use also to measure wealth. Now, more to your point of whether we should kind of first try to create transparency before we try to tax extreme wealth. I think, and that's a standard argument, I think that the way we should think about these issues is like the other way around. It's that it's when you create the tax that you create transparency. Because creating a tax is always more than a tax. You create a tax and you create an administration to enforce the law. You create accounting standards. And that's exactly how it worked for the income tax. A standard argument at the time of the creation of the progressive income tax by opponents, they said, we don't know how to measure income at the individual level. So the only thing we can do is some kind of flat, anonymous income tax at source, like, we take 2% of any dividend distribution, but without trying to measure total individual income. That we can't know. We can't do it. We don't have the capacity to do it. It would be intrusive. It would invade privacy, and you had all those arguments, but look at what happened. We created progressive income tax. We defined rules, accounting standards, norms, an administration, tax enforcement, audits to measure income, to create transparency about who earns income. And so those taxes, they created tax statistics, tabulations of income by source of income, which have been the key source to study, like Tony Atkinson did for the UK, the long-run evolution of income concentration. So it's really the tax that created transparency and not the other way around.
Thank you so much. So I'm going to open up for questions. Let me just explain how it's going to work. So you can just raise your hand. Then before speaking, please wait for the microphone to reach you. I would ask you kindly to introduce yourself before asking your question, and also to keep your questions as short and to the point as possible. I would also love to hear from a lot of the students here, so don't be shy. Actually, there might be a free book for the student who asked the most relevant question. So let's go. Okay, so please go ahead, raise your hand. Okay, so maybe the young lady in the back to start with.
Thank you. Bonsoir, Monsieur Zucman. Thank you so much for being here. So I have a question on the political will that is connected to this tax. I would like to know perhaps also your interpretation of why did it become law in France, and what will it take for politicians to agree to this? And then there's also the question of enforcement. Like once they agree, what will it take for the state capacity to actually be able to collect this tax? Thank you.
You want to take a bunch of them, or you prefer? We can answer directly. So why didn't it become law? Mostly because of the outsized influence of billionaires on the democratic life of France and public conversation and policy making and votes in parliament. So in France, like in many countries, the billionaires own 85% of the private press, 85%. They own all the economic newspapers and magazines, except for one, Alternative Economic, for those of you who know it, excellent. But all the rest is owned by like 3 billionaires. And of course, in those newspapers, it's impossible to write anything that would be remotely sensible about these issues. No, it's just not possible. And then they really campaign very, because sometimes they pretend that they don't kind of try to influence the the editorial content of the newspapers, but they forgot any pretense in the fall when the tax was really close to passing. They really used all the media they own to protect their own self-interest and to stoke fears and to predict all sorts of catastrophes, and also to, almost threaten elected officials, members of parliament, threaten them of some kind of retaliation if they were to vote for this tax. They came out, some of them, strongly with statements saying, I could not believe if any sensible member of parliament was to vote this bill, this would be unacceptable. Like a thinly veiled threat of retaliation. And that has really paralyzed the debate and the vote in parliament. And look, you can look at that and say, well, okay, it's hopeless, we'll never get there. That's absolutely not how I view this. When you look at history, you see that those battles, they always take time. It's never a matter of weeks or months. These are always hard-fought battles because it's about, broadening a little bit the scope of democracy, bringing the billionaires into the system, into the, the realm of national solidarity. They very much like the current situation. They have good reasons to like it from their perspective, to be sure. But it's always a battle. And so what it means is that it's going to take a little bit of time, but I have relatively little doubt that at the end, a version of this will end up passing. It's very difficult to predict the timing. But if you look at the substance of the arguments that were made, it's not like anyone came out with a very strong argument that it's a bad idea. It was really about narrow defense of their interest. And that being said, I forgot the first question, which remind me was on enforcement. Enforcement is especially if you target the very top of the distribution. So we're talking about, in France, 1,800 taxpayers. In the UK, perhaps 1,000 or 1,500 taxpayers. It's a very small population. So you could have really high audit rates. That's the way it works for big multinational companies. They have 100% audit rate. So that corporate tax return is audited each year. And so in the case of billionaires, you could have the same policy, keeping evasion to a very low level.
Maybe in the front now, in the front right here.
Yeah, hello, my name is Felix. I'm a master's student in philosophy of economics here at LSE. And my question is if your title, Billionaires Tax, is maybe a little bit misleading in the way that people would tend to think, okay, it's actually wealth taxation. We don't need to care about wealth taxation anymore. But this is not following your argument, right? Because your argument is we have to find compensation for the income tax avoidance. So my question is, do you think we need like an additional pure wealth taxation, additional to your tax proposal, or maybe is your term minimum tax already implying that idea in a pragmatic way that you could say, okay, first we have to institutionalize this kind of wealth taxation, and then it's easy to increase the tax rate?
Yeah, thanks a lot. Great question. I think, of course, there are many good reasons for wanting rates of more than 2% and for having, for instance, a progressive wealth tax on top of this. 2% on the super rich is the proposal that should be consensual, that all members of parliament, if they think a little bit about it, if they look also at what their electorate wants, if they look at opinion polls, these are, it's a proposal that 86% of the French population supports, according to the many polls that were conducted in the fall. You have never on any economic policy issue, as much support as that. It's the maximum you can get. So it's been designed like that. So the idea is not that we should only do that. The idea is we cannot do less than that. And of course, there are many good reasons for wanting to do more than that. For instance, to be very clear, this proposal would address one specific problem, which is the problem of regressivity, the fact that the very rich can pay less than the rest of the population, which is a serious problem. But there are other serious problems that this tax would not address. For instance, it would not be enough to stabilize or let alone reduce wealth concentration. I want to be very clear about that. It's not going to reduce wealth inequality. And to understand that, you need just the basic arithmetic. Billionaire wealth has been growing 10% a year over the last 4 decades. The wealth of the average person has been growing 4% a year. So if you want just to stabilize wealth inequality at its current level, you need a wealth tax of roughly 6% if past trends continue. If you want to reduce wealth concentration, you need more than 6%. If you take very seriously the discussion about the tension about extreme wealth and democracy, you need, of course, to consider more ambitious policies like some kind of wealth cap, meaning a tax of 100% on wealth above a certain level, what's known as limitarianism. And this is not at all what it's about. And there are very good reasons for having those policies, like progressive wealth taxes with rates of 6, 8, 10%, wealth caps. I think, frankly, it's possible that in the 21st century, we'll have some experiment, surely, with wealth taxation, with capping wealth, in the sense that on some level, everybody agrees that there should be a cap, right? We don't want to live in a society where someone could own 100 trillion in wealth and have so much power like that. So I think, intuitively, we all should be able to support some cap, whether it should be at 100 trillion, 1 trillion, 1 billion, 100 million. That's a very difficult question. I don't know the answer. Nobody knows the answer. Probably would need a little bit of experimentation to learn about what's the proper level of the cap. But so these are very different ideas. And for me, I view that proposal as kind of a step in that discussion. But an important one, like the 1909 People's Budget was an important step in the evolution of progressive income taxation in the UK. So what's really hard often is to move from zero to something positive, and then lots of things can happen and will happen.
Good. Maybe in the front, right there. Can we? Then we'll move up as well. I know that.
Hi there, my name's Victoria. I do various things, but I work with whistleblowers mainly. My late dad studied here, and he was an investor in Clive Sinclair. I'm going somewhere with this. So I'm sitting here with an email from Elon Musk. I'm in communication with him on email, which I'm happy to share with you. The reason is I understand psychology. So I wrote to him saying, would you like Clive Sinclair's papers? I've got them. My dad's dead. Do you want it? So I know how to get into his head. I think we all know billionaires aren't billionaires. For Bezos, Musk, whomever, it's not about money, and it's not really about something's driving them that's more than money. So I think my personal feeling is the approach. And a couple of weeks ago, I was at a talk with Matthew Pennycook, who's the housing minister. And he was saying he wants to get rid of leaseholds. And he said, I'm going to take on the big 4 estates. I live on the Grosvenor estate. I said, well, you think you're going to win that one against Cadogan, Grosvenor, Walden, and Portman? And he said, the government have got big lawyers. And I said, that's not the point. Work with them, not against them. So my argument would be I'm here with an economist, dip into the psychology of this, work with them, not against them. So I knew how to get to Musk. I knew what would make him tick. Clive Sinclair's cleverer than him with the drink problem. And I think if you say to someone, they often say in America with corporate fundraising, if you don't ask, you don't get. If you say to the Grosvenor estate, we're coming for leaseholds, they're going to get annoyed. If you say, listen, let's talk. So my hunch would be, and I'm happy to give you his detail, my hunch would be sit and say, listen, let's talk. Because they're not there for wealth, they're there for whatever's driving them.
Okay, short answer is thanks a lot. I think, I have no insight about the psychology of billionaires. That's not my area. And I think the way I approach it, maybe it's too narrow an approach, but I think it's irrelevant, frankly, what they think and what's in their head. It's not for billionaires to decide what should be the tax rate of billionaires. It's for people through democratic deliberation and the vote. And I think they will fight it. And they have good reasons to fight it. And it's a good sign. I'd be very worried if they were embracing like the tax and saying, "Oh, it's such a great idea," it'd be like, probably, there's some kind of big loophole that they've already found, and so it's great that they hate it. Okay.
Yeah, up there. Yep. Yes, that's you.
Hello, good afternoon. My name is Marco Mantegam from the University of Westminster International Urban Planning and Sustainable Development, and I'm also Brazilian. Recently, you must be aware, Brazil started to exempt people that get paid up to 5 minimum wages from any taxations, with the counterbalance that billionaires and the super rich would be more taxed. Now, an issue that arose is that a substantial part of the middle class, especially, started getting worried that if we start taxing billionaires, then they will flee the country or move their assets elsewhere. I was wondering, what's your opinion on that, and if you could advise those people on what it actually means, like what would you tell them?
I think you're right that there is a concern in many countries that the billionaires, the super rich are untouchable, and that any proposal like that is self-defeating, and it's not serious, and at the end of the day it's the working people and the middle class who will end up paying the taxes, and it's been a little bit I think the way that we've done wealth taxes in Europe in particular has contributed to this narrative because they failed to effectively tax the super rich. They have had a negative, they have led many people to believe that it was impossible to do it. And that's why I've kind of tried to take all of that seriously to propose something that the basic idea is that you cannot avoid it, right? It's been designed like that. So generally speaking, there are two ways to avoid taxes. Either there are loopholes in the law and you exploit the loopholes, or you move to another country that has less tax. And so if you want to prevent that, well, you have to do two things. First, you have to write the law without exemption whatsoever. Hence the idea of starting really high in the distribution. If you have more than 100 million pounds, everybody understands that you have some ability to pay taxes. So you don't need any kind of special treatment, deduction, exemption whatsoever. And second, if you move abroad, you know what? It's not going to make a difference. The tax keeps applying for 5 or 10 years after you've left the country. Okay, and so that's how I think the law should be written. It has to be kept short. If it was to be done in the UK, be mindful, it has to be really short, just 2 short paragraphs, right? Paragraph 1, people who have more than 100 million pounds cannot pay less than 2% of their wealth in personal taxes annually. So someone who already pays more than 2% would not be affected, but someone who pays less than 2% would have to pay the difference to reach the 2% minimum. Period. End of paragraph 1. Paragraph 2, if they move, the system keeps applying. They still have to pay this 2% minimum. And if you write it like that, what the billionaires are going to do? There's just no way to avoid it. Which, by the way, is why they find the idea distasteful. They think it's really bad because they see that, yeah, sure, that one would probably work quite well.
Thank you. In the back, yes.
Thank you. Hi, Mr. Zucman. Thank you for your insightful presentation. My name is Abel, and I'm a Year 12 prospective student. So we've recently seen the influence of billionaires such as Elon Musk in the British political landscape. How do you think the rise of the far right and laissez-faire rhetoric across Europe will affect governments taxing billionaires?
Thanks a lot for a great question. So
the serious contender for the book
yes.
prize.
I think that, okay, so I can tell you about what's been my experience in France. Well, this was discussed like nonstop for like 2 months in September, October, and it had a really clarifying effect on the political debate. because it forced the far right to say clearly what they thought of it. And their answer was very clear. They said, we don't like it. We don't want it. We are against the minimum tax on the billionaires. And they voted against it. And their view was that, it's not possible to do it. We have to accept that the billionaires, there's not a lot of money that can be obtained there. They will flee, they will avoid, we can't do anything. There's a lot of money that we can get by taxing the poor, immigrants, a ton of money, but for the billionaires, very little, not worth the trouble. So that's what they said. And I think, frankly, it's great that we had this clarification because, look, in any society, you always have a small fraction of the population which thinks that the law should be more lenient on the very rich and powerful and harsher on the poor and immigrants. It's always a tiny fraction of the population. It's like perhaps 10% of the population. Most people, they don't like that. They want equality before the law. And I think the fact that the far right was so clear in saying, no, we want this inequality, this level of inequality, we embrace it. The billionaires, they should live tax-free. I think it's going to harm them eventually a lot. And I think, frankly, it's going to help left-wing parties if they were to campaign on those ideas more aggressively. It would help them a lot. These are very popular ideas in the public debate everywhere.
Let's maybe go in the back over there, and then we'll come back here. Thank you.
So, hello, my name is Dennis Samoa. I'm a DPhil student from the University of Oxford in international tax. So you mentioned that the law could be made clear where, the second provision will talk about if someone leaves, then the person is taxed for 5 to 10 years. But my question is, does that not affect the sovereignty of the receiving country? Because you're going to tax that person for 5 to 10 years. And also, how then do you determine that the income that the billionaire has created over that 5 to 10 year period is not affected by the previous country? How do you deal with the conflict of law situation? Because that's going to be difficult for countries that will challenge the basis on which you will tax a billionaire that has left. And related to that is also the difficulty of, I think you mentioned that a bit, the valuation, liquidity, and how it doesn't operate as confiscatory, technically, to billionaires who are making that kind of thing.
Thank you. That's a good one.
Yeah, okay, these are tough questions. So on the first one, the short answer is no, it's not impeding, infringing the sovereignty of the new country. Because the system that I describe is any country can do whatever they want. They choose their own tax rates. They're free to do so. They can choose zero tax for billionaires if that's what they want to do. That's okay. But there has to be a tax collector of last resort. There has to be one country that says, okay, if billionaires move to your country and they pay no tax, that's your right as a country not to tax them. But, they build their wealth thanks to public investment that occurred in our country, or more broadly, thanks to all the knowledge that was accumulated over centuries. So they have to pay some tax somewhere. Okay, that's going to come kind of compensate the fact that they don't pay in their new country. But what's really important to understand, I'm sorry if that's not as clear as it should be, is that if someone moves to a country and that country taxes that person as much as in the UK, let's say, then the UK would not collect anything extra, right? The UK would collect just the difference between the 2% minimum tax rate and what the person pays in their new country. And again, their new country is free to do whatever they want. It's just there's going to be something extra. That will be collected in the UK if the taxes in the new country are too low. And you're right that, of course, even though it does not infringe on sovereignty, it changes the incentives for the other countries, because then the new countries would have incentives to tax the billionaires themselves because by taxing the billionaires themselves, they would collect the tax revenues for themselves rather than letting the UK or the origin countries collect the tax revenues. Okay, so it would change the dynamic of tax competition. You know, that's the type of policy that can replace the race to the bottom, the dynamic of tax competition by some kind of race to the top. As soon as you have one country or a group of countries that play this tax collector of last resort, then the tax havens have an incentive to increase their own tax rate. So that's important. And as always, I forgot a very tiny memory. Liquidity is also a classic concern where the answer is that we're not going to reinvent the wheel. Many countries already have a wealth tax, which is the inheritance tax or the estate tax. It's one-off, it's not annual, but it's typically with rates that are much higher than 2%. So it could be 40, 50%. Even if the effective rates are less than that, it's much more than 2%. And so in the context of estate or inheritance taxation, you have liquidity problems. Like when it's an inheritance tax, you have some people who can inherit a lot of wealth. They have to pay a lot of tax. They don't have the liquidity. And so we know how to deal with those problems. Number one, you can allow payments to be made over several years. Number two, you can allow people to pay in kind. So for instance, in France, if you inherit, like I'm sure many of you in this room will soon, if you inherit very valuable Picasso paintings, you can pay the inheritance tax with the paintings, in kind. You don't have to generate liquidity. And so what you could do is you could kind of generalize those methods of payments by allowing people to pay the minimum tax in kind, meaning with shares of the companies that they own. And then the government could keep the shares in some sovereign wealth fund, or it could resell the shares, perhaps first in priority to the workers of the corresponding companies, and otherwise to other investors. And you could also say that those shares can only be sold to domestic investors, so that all the shares remain domestically owned, whether by the government or by the workers or by domestic investors. So all of that can be done in the rare cases, because these are very few cases, rare but real, where there are genuine liquidity problems.
Okay, maybe on this side, yes.
Thank you, Professor, for the wonderful lecture. I'm a first-year undergraduate student studying politics and economics here. So my questions are, given that there's huge political influence from billionaires, and when there's, for example, elite capture in democracies, and also given that there's the tight link between economic benefit and political benefit, especially for the top income level, how do we incentivize the politicians enough that they can pass the proposal and implement it? And also, even if we get it implemented and when the tax is collected, how to ensure that it is held accountable, that there's no corruption? And also, like, having this successfully implemented means that the government has the power to do so. Then can we like ensure that this power isn't overused over time, and we can hold it accountable that it doesn't erode other aspects of economic activities?
Okay, thanks a lot. These are really tough questions. How do you make it happen concretely? I think, obviously I don't have the recipe, but the only thing I can say is how it has happened historically when in similar situations, and it's always a mixture of kind of social movements, political mobilization, and sometimes the circumstances matter a great deal. And it's true that in some countries, like France, the Senate blocked the income tax until the very eve of World War I, where they were like, okay, now maybe we need some tax revenue, and so they were forced to vote it. And so it has led some people to the view that you only see change like that in the context of really major catastrophes like the world wars or pandemics or or economic crisis. And I don't think that's quite true. The standard counter argument is look at how Sweden built its welfare state and transitioned from one of the most unequal countries in the world in the late 19th century to one of the most equal country in the second half of the 20th century. And it all happened through social movements, and unions in particular have a very, very important role to play in all of that. And perhaps the unions should be more involved also in managing some of the resources generated by this minimum tax on the super rich. Perhaps if some of the money went was targeted to public pensions or healthcare, it could give some incentives for unions and to be more closely monitoring all of that. So you need actors in society with a stake in making the tax work well. And then about the risk of overreach, I think you have to believe in some sense in kind of some rationality of the voters. And so you have to believe that, yes, there's going to be some experiment. Maybe we'll start with 2%, and maybe, like the income tax, it went pretty much all over the place, right? From 2% to 100% for the top marginal income tax rate. And there's some learning and there's some experimentation to be done. And at the end of the day, that's, I think, the only way that we can really learn about kind of the trade-offs involved with these different tax rates, and we can make rational choices collectively. So I think we should more like embrace the possibility of some experimentation like happened, I think, quite successfully for the income tax during the 20th century.
Thank you. Yes, you were next. So, and then we'll take maybe right there in the fourth row. And we'll take maybe one last question. So.
Okay, so I'm Olivia and I'm a year 12 student. And my question is, do you think imposing taxes on billionaires could inadvertently discourage investment and entrepreneurial risk-taking? And if so, how might that affect economic growth in the long run?
Very important question. I'm not too worried about this. And I think it's quite intuitive, right? I think, look, I've lived for a long time, for instance, in the San Francisco Bay Area, and I've had thousands of students literally who went up to work in tech, creating startups, and never once did any student come and tell me, look, okay, professor, there's really one thing I'm worried about, is the possibility that if I make it into the billionaire club, I might have to pay a little bit of tax. And hence, I'm considering changing my plans and doing something else. Entrepreneurship, is not for me. AI, let's forget about that. No, it doesn't work like that, of course, because what matters for the creation of startups, entrepreneurship is, is public infrastructure, is the skills of the workers that you can hire. So it's the quality of higher education, it's various government regulations, but certainly not, at least not in a significant manner, the amount of tax that you would have to pay in the extremely unlikely event that you have such a considerable success that your personal wealth is going to exceed 100 million or 1 billion. And so I think there's no risk here. And I go beyond that, and I would say that the net effect on innovation and growth would be positive, would be slightly positive. I'm not saying we're going to double GDP growth, but it would be slightly positive because, of course, with the money that you can get from that tax, and 15 billion pounds for a country like the UK is not small change, it's not negligible. It's money that could, and in my view, should be invested massively in education, in particular in higher education, in research, which is the core engine of innovation and growth and productivity gains. And so if we do it that way, I think there will be a slight positive effect on growth.
Thank you. It's a tough one. Yeah, right there. Thank you.
Hi, Stephen Hunsaker, Resolution Foundation. I had a question about if more in the UK context, that if the appetite for a wealth tax in the UK grows, let's say under a new prime minister. Should the government focus that on as a revenue generating mechanism, or as an actual as an inequality, a wealth inequality tool? Mainly because, as you've said, the proposal for a 2% is not progressive in nature, but helps it not be, it's not regressive. It's helping address a regressive tax that exists. And so in the UK context, what does the success of something like that look like for the government to sell to people?
Yeah, that's a very important question. And clearly the answer is that with proposals like this, 2%, even if it was 3%, 4%, you're clearly in the realm of revenue generation. It's not, it's not going to be reducing wealth concentration. Again, because the arithmetic, the wealth of those individuals grows 10% a year, as opposed to 4% for the average person. So if you want just to stabilize wealth concentration, you would need wealth tax rates of like 6% on billionaires. If you want to reduce wealth concentration, you would need more than 6%. With 2%, what's going to happen is that wealth inequality, everything else equal, is going to keep rising, but at a slightly lower pace than the business as usual. So it's not going to be about curbing wealth concentration. You will need other tools, which personally I would support, but I think with that type of proposal, it's about the money. It's only about government revenue. And not only that, it's about fixing this fundamental anomaly and unfairness in our tax systems, but from a, it's also very importantly about government revenues, about how we address the very serious public finance problems that we have, and also we generate the resources that we need if we want to keep investing in what's really key for growth and productivity in the future: education, healthcare, public infrastructure, the energy transition. Here you can get 15 billion, and it's not going to be enough to meet all those revenue needs, but it's necessary, right? Because if you don't start with that, if you don't tax those who are both the wealthiest people and the least taxed in society, what else can you do? And also, it has to be the starting point. Of course, not the end point, but you start from that and you get a serious amount of tax revenue, and then it opens up a realm of possibilities for additional tax reforms.
Thank you so much.